Interest rates are rising. Does that mean the death of the real estate market? Positive and negative outcomes of rising interest rates. In recent months, we have experienced a significant shift in the real estate market from a fast-paced, price escalating, low inventory environment to one in which prices are stabilizing or decreasing, the extent to which depends on the area and type of property. We now have higher inventory levels and longer days on market because of these higher interest rates. So you may be asking yourself, exactly how are higher interest rates affecting the real estate market and what does it mean for me? In today's video, we're going to look at why interest rates are rising, how higher interest rates are affecting the real estate market, what higher interest rates mean for you, the buyer and seller, and a case study of how these interest rate increases are affecting mortgage payments and mortgage qualifications, as well as what we can expect in the coming months. Inflation has been a key concern of not only the Canadian government, but governments around the world. To combat rising prices and inflation, central banks have been increasing interest rates. The rise of interest rates leads to a chain reaction of events. Higher interest rates increase the cost of borrowing and of debt. These changes typically discourage borrowing, which in turn lowers demand and slows the market. This is the premise on which governments are relying in an attempt to curb the inflation that we are currently experiencing. The challenge is to raise interest rates to lower inflation without causing a recession. Reduced demand has affected home prices, reduction in home prices from earlier this year, and an increase in the days on market. Sellers have had to reduce their prices to remain highly competitive and attract from the limited pool of potential home buyers. To sell their home, sellers must price their home competitively, market aggressively and creatively in order to sell. If economies grow fast enough, the effect of rising mortgage rates will have a limiting effect if salaries and wages also increase in similar amounts. But to curb inflation, the rapidly rising interest rates have not afforded this luxury. The risk is a recession, which is a general decline in the overall economic activity. So what are you to do as a buyer or a seller in the current economic climate? As a buyer, you are subjected to interest rate increases, higher borrowing costs that translates into higher monthly payments. These higher interest rates also affect the amount of money that lenders are willing and able to lend you based on mortgage rules and debt service ratios. For example, if you were previously approved for a purchase price of $900, you may find yourself now only able to purchase for $800, but your monthly payments for that $800,000 purchase may be higher. Let's take a look at mortgage payments and how the affordability is affected when interest rates rise. In this particular example, we're going to look at two purchase prices. The first purchase is for a $900,000 property with 20% as a down payment, which is a conventional mortgage, meaning there is no CMHC insurance fee required. In this case, the down payment would be $180,000. The financed amount would be $720,000 for the mortgage. Now let's take a look at a fixed rate of 4.4% with a 25-year amortization and monthly payment frequencies. The monthly payment in this case would be $3,961.24. Now in scenario 2, we're going to look at a purchase price of $800,000. Again, a down payment, which is $160,000. The amount financed would be $640,000 for the mortgage. Now in this case, we're going to raise the interest rates by 1% to 5.4% fixed with a 25-year amortization paid monthly. So we are raising the interest by 1% and we are reducing the purchase price by $100,000. Let's see what happens. In this case, the monthly payment is $3,869.33. Let's take a look at the two scenarios side by side. In the first scenario, we had the $900,000 purchase price. At 4.4%, the monthly payment was $3,961. In our second scenario, we had a purchase price of $800,000 with a 5.4% interest rate, so 1% more. And the monthly payments were $3,869.33. So the difference in payments, although the purchase price came down $100,000, with the 1% increase in mortgage rates, there's only a difference of $91.91 between the two. So it shows you that people would pay the $100,000 more and have relatively the same amount in terms of monthly payments. Now, if we were to compare apples to apples, the $900,000 at the 5.4 and the $800,000 at the 5.4, we can see that the difference in the monthly payments would then be $483.64. So it just sort of gives you an idea as to what happens with the interest rates compared to reductions in purchase price. The example shows that mortgage rates significantly affects the affordability and purchasing power of buyers, despite decreases in the actual purchase price. Sellers need to be aware of increased interest rates and their impact on buyers. The pool of buyers has decreased, and so too has demand, resulting in longer days on the market and fierce competition for the limited pool of active buyers. Sellers need to position themselves for these changes to successfully sell their properties in today's market, determining exactly what is happening in their local community and price point, ensuring that they not only price their homes right at the beginning, but also ensuring that their homes show well and are strategically marketed. Buyers who are waiting for the market to change and for prices to fall should also keep in mind what that means. As interest rates increase, the ability to qualify will unfortunately decrease and monthly payments will increase, keeping prices in check. Once the rates decrease and affordability increases, so too will the demand, which in turn will put an upward pressure on prices. It's a fine line. So what should buyers do? The answer is it depends. Each buyer has a unique situation. If they have a strong motivational factor to move, such as a need for more or less room, or a change in status or location due to a job, and they have the means to purchase, now may be a good time to buy. As prices become more favorable, as inventory rises, buyers now have choice and the ability to negotiate and include contingencies in their offers. Although these buyers will be paying more monthly in terms of carrying costs, they may have the option to refinance later. This is where a good mortgage specialist will be able to advise you of your options. Need a great mortgage broker? Contact us, we can help. The challenge is overall housing inventory. We have a shortage of homes with a limited pool of existing and new builds to meet the demand. And while the population continues to increase and more people enter the market, inventory levels will continue to strongly impact prices. If we wait for rates to come down, yes, our monthly carrying costs will be lower and we will be able to qualify for a higher purchase price, but at what price? As interest rates fall, increased affordability and demand, prices will rise. It is a fine line, and each person needs to determine what is right for them. If you need help figuring out what your options are, feel free to reach out. We're here to help.